The Fed just cut the interest rate, but here's the shocker. Mortgage rate actually went up. Doesn't sound right? Let's break down the top 10 things you must know so you can understand exactly what's happening in today's market. Hi, I'm Jack Ma with Century 21 Master. I help family in the San Gabriel Valley and North Orange County area buy and sell homes. So staying ahead of these shifts isn't just important, it's critical. The Fed makes a move, Wall Street reacts, and then the housing market takes its own turn. But the connection isn't always what you expected. Let's walk through the 10 key insights and explain this surprising shift. Number 1, last year's warning sign. The last time rate dipped this low was August of 2024. Within just 5 weeks, they shot back to 7%. Now, it's a reminder that these windows don't necessarily last forever. Number 2, why rates dropped before the Fed. Market moved on anticipation. Investor expected a bigger Fed cut, so mortgage rates started to fall ahead of the announcement. But once the cut was smaller than hoped, rate reversed and jumped right back up. Number 3, mixed signal after the cut. It wasn't just the size of the cut, it was the Fed's tone. By trimming only 0.25% and sounding cautious, the Fed basically said, don't count on aggressive cuts. That shift in message pushed mortgage rate higher, even after the cut. Number 4, uncertainties ahead. Tariff, inflation, and the global slowdown remain wild card. Any of these factors can move mortgage rate sharply in either direction. Number 5, the tug-of-war effect. A weakening economy means more people need to sell. Job loss, higher costs, or financial stress push them into the market. But at the same time, fewer buyers are willing to step in because confidence is shaky. That creates a push-pull dynamic. And remember, the Fed only cut when they see weakness. If the economy were strong, they wouldn't be lowered the rate. Number 6, consumer confidence. Rate cut also work on psychology. Buyers hear rates are lower and suddenly feel more confident about taking action. Confidence often drives activity just as much as numbers do. Number 7, real impact on buyers. Every half percentage drop in mortgage rate can save buyers hundreds of dollars a month. That's why urgency is building. Affordability has improved. Number 8, seasonal surprises. Normally, fall and winter brings a slowdown, but with new listing shrinking and demand picking up, activity is holding steady or even rising. Number 9, investors re-enter. Cheaper borrowing costs improve cash flow. Investors are starting to re-enter the market, which adds another layer of competition for everyday buyers. Now lastly, number 10, perspective on rates. Compared to 3% era, today's 6% feels high, but historically it's moderate. Perfect timing is impossible. Strategy and execution matters more than chasing the exact numbers. And here's some perspective. For affordability to return to the level we saw during COVID, interest rate would need to fall below 1%, which is simply unrealistic. So, what does this mean for you? This may be one of the best window of opportunity we've seen all year. Now, for buyers out there or prospective buyer, you're still got a lot of inventory to choose from because new listings are only just beginning to slow. Combined with the big drop in interest rate, now you got a rare combination of more selection and cheaper monthly payments. And for the prospective sellers out there, after an entire year of increasing supply and decline in demand, the script have flipped. Fewer listing and more buyer means conditions are swinging back to your favor just ever slightly. And by the way, who do you know? Friends, family, or neighbors who's been talking about making a move? I'd be honored to be a resource for them. I'm Jack Ma with Century 21 Master. Thank you for watching, and I'll see you in the next update. Bye-bye.